Good evening. This is Ken Long from Tortoise Capital with a review of the weekend trading report for August 25th, 2017. Market is in bullish volatile conditions. On an annual basis with NDX 260, we are at overbought at 98. On a 10-day basis, using NDX 10, we are in the middle of neutral at 48 out of 100. Considering the market mosaic, we are green bullish with respect to the 200-day moving average at 3.84%. The slope of the 50-day moving average is stabilized at 0.04, but that's still red bearish. ADX measure of trend is very weak at 6.9. The risk index is the 30-period moving average of the VIX divided by the 10. The threshold between risk on and off is 1.0. The current reading is 0.904, so we were deep into risk off. The risk Z is the Z-score of that number. We look back 5,000 trading days, find the standard deviation and the average, and compute risk Z at minus 1.17 SDs below the long-term average. You can see here a 90-day histogram, and we actually have some improvement. And typically this is an area in which in bull markets we can start looking at swing trades as volatility has begun to quiet as it starts ascending the slope. That actually starts favoring long side swings. Blended monthly rebalancing, we'll be making some changes later this week. The current holdings you see noted here, and the current leaders based on the closing prices as of Friday. In ETF2, theoretical exposures at 80%, model portfolios at 100%. Here's that blended monthly rebalancing portfolio lens looking at the ETF 13 and 32. Mostly on buy signals, some weakness in U.S. small caps and mid caps, and in the 32s, notice it's in the energy and ag and staples areas. I like looking at things that are green across the board, so Latin American emerging markets may have some opportunities for additional momentum this week, along with China and the Brazil index. In ETF Max, get some China is near the top. Turkey, palladium had a bit of a pullback on 1 week, but real strength here in Brazil, Poland, and copper. Copper bodes well for the business sectors, the manufacturing sectors, I should say. Market health check. Just notice the vertical blue lines are 10, 20, and 30 days worth of look back. 30 and 60 are the solid lines. Horizontal red lines are resistance levels that were once support levels, and these act as price targets on the way down. We're finding support here around 242-ish, and this with a little bit of healing this week, we would see this as a pocket reentry, and this would be considered leg 1, leg 2, leg 3, and the fact that it is held above this support level says now a retest to 247, 248 is still in the cards. It has to really get above 247 and a half to be long-term really favorable. The slope of the 10-period channel and the 30-period channel are both decidedly down. You can see the 30-period regression lines moving slope value here. Blue lines are where it's crossed into the negative, and you can see and greens have been the highlights. Red is where it had a local minimum, and now we are below the zero line, but starting to find some stability here. As you see, the slope is decreasing, and at a negative value minus 1.0, this is still all very much well within historical norms for being just a noise pullback. That would find support here all along this Z-1 southern edge of the river, and the upward trend would still be intact. The fact that it's pulled back this far now gives room for some gains back up to the swing high. On the downside, targets are 244, 241 and a half. If that breaks at the belly of the dragon, then the next real targets 239, 238 happen pretty quickly in my view. Regional report for ETF2. The globals at 62 are still stronger than the U.S. at 56. Inside the U.S., it's small caps, then tech, then large caps, and then mid caps are lagging. 8 of the 10 indexes are on buy signals, so it keeps us at 80% invested, 20% cashed in the theoretical model. Real weakness here in materials and industrials. Again, you see the U.S. below average, except for the large caps. Mixed bag in Europe, or in Asia, excuse me. Europe generally all above the zero line, above average. Latin America, emerging markets, Mexico and Brazil is where the strength is. ETF top 30 based on the ETF2 lens. Those that are green in strength and green in consistency are ones that have been dominating. Those that are green in white or green in yellow, and I keep Belco in just for reference, are the ones where we have some emerging strength, where it's currently strong and the consistency hasn't caught up yet. So that's places in which some more gains could be emerging as it moves to the top of the stack. Those that are white and green are ones in which that longer term outperformance is starting to decay. Shifting to the daily, again, market bullish volatile here. No signals in channeling and overreaction. A handful of good channeling and overreaction signals here. Lots in the auto framer to choose from. Many auto framers testing out very well indeed. A couple frog quality numbers greater than 3. Also in the ETFs, again, half a dozen testing out better than 2 to 1, with VIX and XIV really being the extreme, so extreme that the others are just lumped kind of in the middle. Daily pinch and stretch. Again, we're looking at 4 categories. The first two dealing with the price, the 1 day stretch above or below the river on both a percentage and a z-score basis. Only Nike is exceptionally stretched in either direction, although UTX is pretty close. And then the river is wide or narrow. This is a function of the 30-day pinch box, or the 30-day standard deviation compared to a 500-day look back. And so the ones that are highlighted in green and red are ones that are exceptionally wide or very narrow, and these are ones in which we've already just seen an extraordinary move in the case of the green, or a lack of a move, which are the ones that are highlighted in red. And so these all become extreme conditions and with the potential for a sudden and significant change in state or a continuation of the momentum in the case of the ones that have been moving. So Verizon, Nike, and Boeing are on my short list for continued follow through. The super pinch candidates are ones that come off of this list, the most compressed pinch boxes, and then also all 4 regression lines, the 10, 30, 90, and the 270 are all within the pinch boxes. And so these are ones in which not only are the exceptionally narrow range of the river, but also uncommon agreement on fair value across all the different time frames. And so these are ripe for changes in directionality, breakouts from compressed regions. And these are ranked in accordance with their the degree of their pinch, how tightly the regression lines are pinched. So Pfizer, Technology, Microsoft, these are all ones that are looking good for possible breakouts. See the leaders and the laggards here in the regression line fractal framework as well. So Verizon and Boeing, the most above, most number of ATRs above their own RL270, so maybe overheated. 5 and then 4.5 ATRs above their RL270. Case of IBM and GE, more than 8 ATRs below their long-term fair value. These become of great interest to us for that reason. Market conditions looks to me stabilizing here above 243. a logical place for that slope to make a turn. If it does, then this sets the stage for a potential really nice swing. Collapse below 243 gets it down to 235 pretty quickly, though. And the trend is down in terms of that slope value of that 30. And that's everything that I want to cover now. With the exception of where price is with respect to the river, holding right here on the southern edge as it is. The last time it did that here and here and here, there followed a nice swing after the pullback. The fact this was a double bottom, and Trump is so active in the Twitter sphere, uh, makes us wonder, could this be a collapse back down to 230, 235? But if it holds here, then a move to retest 249 is in order, and then if it breaks above that price level, it'll be free and clear, and everybody will think it was an obvious move. So that's everything I want to cover from the weekend report. The short-term trade is still very much favored. I am directional neutral intraday, and I'm just looking to find the mover quickly and using these ones that are in pinch and stretch conditions really to key my radar in finding them early. So, it's Ken Long from Tortoise Capital. Keep your risk measure and your powder dry.